Hey, good afternoon. How's everybody? Hello?
Professor.
Yeah, good. Can you hear
So
me?
Yes, we
I
can hear you.
can. Good,
loud and
good,
clear.
good.
Hi there.
Great, great. I always have to check because the setting sometimes the setting changes every time I uh, log in again, and I didn't make the change, but the setting has somehow changed. So okay, so we have, it looks like we have 10 people here today, and 10. And in the forum, there should be also 10 people. And I see, yeah, so we have, matching number of people in both rooms. Give me a second. I'll have to. Okay, it's quite a day today. The humidity is, very high. It's like um, almost like Turkish bath. The heat and the humidity and everything. Um, Hope you guys are staying cool today. The AC is. Some people may have power outage, because everyone must be blowing up their AC to max. So uh, just let me quickly catch up with where we left off yesterday. And, so we're going to Ontario. Oh, it's always taking so much time. So slow. Okay. Uh, Towards the end. Where's the volume? Where's that? Okay. So so basically, yesterday we wrapped up everything about the reasoning or the logic behind the income statement. So uh, we're gonna take a look at the income statement example today. So let's open this Excel file. Okay, open the Excel file. Okay. Oh, why does it take me here? Can I not open it directly? Oh yeah, I can. I guess I can open it directly from there. Okay, this isn't necessary. Okay, if you open this file, right? Uh, if you look at the bottom tab, I think the first bottom tab, uh, it will, if it is going to open right here, then it will be wonderful. If it doesn't, you can just click, you can just click on the first bottom tab, okay? And these numbers shouldn't be filled in there. Do you have them? Do you have these highlighted cells blank, or are they filled in? They should be blank, right? Just let me know. If it isn't blank, please
Professor, I think
delete.
they are not blank though. I'm currently
They are
looking
not
at
blank?
the examples on your end, and a few of them are blank, but not all of them. No.
Okay, what's important is the highlighted cells. So if
Okay,
the highlighted cells are not blank, please clean them out,
gotcha.
okay? Okay, and then all of them, just clear them out. I keep using this, and then, it is saved automatically online. So uh, once I work on it, then it's automatically filled in. And I have to, of course, I'll have to clear out everything. Clear contents. Okay. So first, it looks so messy, but let me income statement first. Now, first of all, I think I updated. Let me just check. I think I updated that file, so it should be like a blank. Let me just check. Oh, they are filled in. Why? That's weird. Okay, so that's why I told you to. I'm gonna have to. I guess I'm gonna have to update it. It shouldn't be filled in like that. Okay, all right. First, basically, income side, right? Income section, and the conclusion of the income section is the net revenue, and of course, sales revenue. We got the sales revenue there, and then um, second, that's the primary source of our income, right? Secondary source of income is investment income. Okay, that we know. We know that already. Let me get rid of that. Okay, and then uh, what about returns and allowances? What does returns are easy to understand, right? We sold something. We sold merchandise or services. Uh, if it is services, I guess hard to return, right? Service has been performed and then, or service has been rendered, and that's it. You can't return the service, right? Uh, but it's merchandise, obviously, if the return is possible. Uh, so return is obviously a negative number, right? Because it's cash outflow for us, right? You have to refund, so cash out. Then what is allowance? Allowance is a discount. If you, to put it straightforward, to put it in simple terms, it's discount. But why? I mean, why don't they just call it discount? Well, there's a difference. Uh, and you have to remember, you have to keep in mind that all these statements are B2B, B2B context, right? All these statements are in B2B context, not B2C. Uh, and in B2B, right? Uh, some if we are selling something, we are probably uh, like a vendor or supplier of parts and components to a large manufacturer, right? So suppose we are making computer peripherals like keyboard, uh, some small batteries that go into the laptop, or let's say we are part manufacturers of components. So we sell those to the computer manufacturer, and then uh, sometimes we we want them to buy in huge quantity. So if they buy in huge quantity, we give them discount, right? It's called volume discount. In B2C, that doesn't happen because you go to an Apple store to buy an iPhone. How many iPhones are you going to buy, right? And those two, one for you and one for your spouse or partner, or um, probably one for your a child, or one for your parents. You don't buy like a dozen of iPhones, or you don't buy 10 dozens. So there's no such thing as volume discount in B2C context, but in B2B context, volume discount is a quite common and frequent thing, right? Isn't it right? So, uh, and you may have heard of a supply channel, right? Especially earlier this year, we've been we've been suffering from uh, supply supply chain disruption, and as a result, supply shortage. That's why everything got not only because of the low interest rate that has been supporting the economy and the stimulus packages, but also uh, the supply bottleneck in the supply. So yeah, supply chain is basically from think about it. Supply chain is that's actually marketing terminology. Supply chain is uh, obviously from the raw material producer, and then raw material wholesaler. The raw material wholesaler will supply the raw material to the manufacturers, and the manufacturers will uh, with the raw material they will make parts and components, and the parts and components will be again supplied to the manufacturers of the complete item, right? So and there's through this chain, right? Through this supply chain, there's also transportation, right? Cargo vessels and trains and freight trains and all of these. This supply chain. Now, so basically, allowance is a discount given to the supply chain members, right? Only within the supply chain. So consumer is not part of this, supply chain. Consumer is actually at the end of that, supply chain. But supply chain actually ends at the retailer, and the consumers are dealing with the retailer, right? Uh, so allowance, once again, allowance is a discount given to the chain members, supply chain members, right? Usually volume business. So obviously that would be negative, right? Because it's cash outflow from us. So since this is already, we know what to do now. Oh, what did I try? What am I trying to do? I was trying to delete that, but I kept hitting the power button, and it's a good thing the computer didn't shut down. Uh, okay, so all we need to do is uh, to find the net revenue. All we need to do is just sum everything, and we can use this auto sum command. The symbol is already, or the icon is already there. So if we click that, it's going to sum everything above it, right? It's going to sum everything. And since this returns and allowances, it's already in negative, um, it's going to be subtracted automatically because when you add them up, it's going to be, because it's negative, so subtracted automatically. So we hit enter, and we get there, right? Let me get rid of these. Oh, I see what they are. I put 1 and 2. Okay, that means revenue. If I were to write, if I were to write it in, I should have wrote it in. Ah. Oh no, redo, please. Redo. Okay. All right. So we came to net revenue. Now we need to calculate the direct cost and indirect cost. Expenses section. But first, it's the direct cost. It's directly related to production. So in other words, total variable cost, which is also called CGS in account, and the OPEX, uh, which is operating expenses, indirect cost. Now, interesting thing is here. Okay, let me get rid of all of this. Now, interesting thing. Now, where is this thing? This thing is total variable cost, right? This is total variable cost. Of course, we know. So, if ever, shouldn't that be broken down into cost of capital, cost of labor, cost of raw material? Uh, yes, it would break down into cost of labor, cost of capital. So capital cost, labor cost, raw material. But that is manufacturing. Manufacturing. It looks like this is not manufacturing. Uh, this is well, you don't see anything like cost of material, cost of. Instead, you see beginning inventory, net purchase, returns and allowances, and ending inventory. So what is this all about? This is a typical example of retail business. Typical example of retail business. Isn't that right? Because retail doesn't make anything. They buy from the manufacturer. They cannot break it down into a cost of labor or cost of capital, raw material, right? Instead, um, they pay basically all their they buy the merchandise from the um, they buy the merchandise from the manufacturer, right? And that merchandise is called inventory. Think about it, right? Okay, so this should come on. Oh, what is the problem? Okay, I'll just do it like this. So, and this is something actually. This is something you would see in the also the balance sheet on the balance sheet, because in the balance sheet uh, there's a line item called inventory. Uh, so inventory generally um, is a balance sheet line item, but it can also appear in the uh, income statement if it is retail. Because you remember I told you previously that all line items in the balance sheet and income statement are different because they serve different purposes, right? Income statement and balance sheet serve different purposes. But if there are two line items that are common in both, I told you it's depreciation and interest payment, right? Or interest expense. And I didn't mention inventory because it's not common uh, if it is manufacturing, right? Uh, you would see if it is manufacturing, uh, your CGS is all, it will be detailed or broken down into those, uh, direct inputs, direct factors, right? Direct inputs of. However, if it is retail, then you don't have raw material, you don't have labor, you don't have, use of capital. So they just strictly they buy, the inventory from the manufacturer. So they strictly express uh, the total variable cost side, that section, only by inventory. So the inventory, especially if it is inventory, if it is manufacturing, inventory breaks down into three categories. One, uh, there will have to be there has to be raw material, isn't that right? If you're a manufacturer, you will need to have raw material. Two, and finally, think about it. It you put the raw material into the production process, right? And at the end of that production process comes out what? Raw material turns into what at the end of the production process? What does it turn into? Anyone?
Final good.
Yeah, who said final good?
Shirley.
Shirley. Okay, that's the idea. Huh? But actually, the correct term is finished goods. Finished goods, right? But anyway, that that's logically. I mean, think about it. Only Shirley can. Oh, Shirley is the only person who can do the logical thinking. Huh? What about the other people? I mean, by any sensible thinking, right? Raw material turns into final goods or finished goods, right? At the end of the production process. Okay, surely you got 0.5. So at the end of the production process comes out the finished goods. But number two, what does that mean? That's basically between that's the stage or state between the raw material and finished goods. So the in between state. So what is what is in-between state? In-between state is while that, the raw material, first, raw material went into the production process. So, and it's the state before it comes out as finished goods. So the in-between state is, you can all imagine what it means. The state, it's in the production process, right? It's the state of the good that's still in the production process. So what should we call that? What is the name for that? Also, just think logically. What would be the name? What would be the logical name for that? Anyone? But we all understand what it is. It's like, half assembled state, right? Half processed or half assembled state, or partially processed, partially assembled state. And if the product is in like partially processed state, what should it be called? Is it so difficult? Huh? I mean, it's called goods in process. And literally that's what it means, and that's what it is. Isn't it right? Goods in process, or another name is work in progress. This is something you constantly use, Also, I mean, if you ever had a job and you were working in a company, and so what was the last project I gave you? I mean, how's it going? Well, it's work in progress. We use the term very commonly and frequently. So think about it. These names are really logical, and there's nothing. Then think about it. All of these are called inventory in manufacturing. Because think about it, in manufacturing, they all cost you money. I mean, you had to buy raw material. That's part of, so you use the company's, asset, company's capital, right? Company's liquid assets, or, company's, current assets to acquire raw material. So it's something you have to really have to track down very carefully, because otherwise the company's money is wasted, or if you lose track of that the company's precious company's capital has evaporated without you knowing where it's gone. So you got to keep track of where it went. I mean, if the company used $50,000 to buy raw material, then you have to keep track of that raw $50,000. Some of it went into goods in process, went into the production process. So some of it is now goods in process. It's hard to put dollar value to goods in process, but suppose originally this was 50, right? And all of the 50K, there's no space for that. Suppose all of this 50K went into the production process, right? Then at least it's hard to put a dollar value on it, but at least it should be worth at least something more than or equal to 50K, right? Of course, as I said, it's hard to put dollar value on it, because if it is something like a automobile or computer, right? The work in progress it's not fully finished car, or it's not fully finished computer, but at least if you break it down, if you disassemble it, at least they come back to the original raw material cost. Isn't that right? You break down the car, or break down the computer, disassemble, right? Not chop it up, disassemble every part by part, component by component. Then at least you have those raw material back in their original value, in their original cost, right? You can sell them back at, probably near its original cost. But however, if it is something like food, right, it's gonna be, you cannot reverse it back to its original raw material. I mean, if you're baking, a cake, the flour that went into that, sugar that went into that, butter that went into that, you cannot reverse that back to right? If it isn't already half processed state, there's no going back, right? So that's why then it becomes very difficult to put dollar value on it, right? But at least you should keep track of where that raw material went. That means in other words, where that $50,000 went. And then, so if it is in half process state, there's no going back. You have to bring it to the final stage, which is the finished goods. Once it is finished goods, its value won't be no longer 50K. Isn't it right? If the raw materials were 50K, suppose you're making computers, and the 50K was the raw material, parts and components. And with $50,000 worth of parts and components, let's say you can make 100 computers. Let's say you can make 100 computers. Then once finished goods come out, that's 100 computers. And then each computer will be sold for at least $800 then. Isn't that right? It should be sold for $800. So then the total will be what? 80K. Isn't that right? So in other words, the finished goods, why? Because the finished goods definitely, what happened between the raw material stage, what happened between the raw material state and the finished goods state? What happened? What happened? Anyone? Can anyone explain what happened? Why did the value go up? Of course, it goes without saying, there has been added value, right? Value added. You don't know what VAT is. A lot of people just, use the term. They say value-added tax. You have to pay VAT, value-added tax. But what is exactly? What does it exactly mean? Nothing mysterious. I mean, a finished good, right? A complete finished computer is more than just some of the parts. Isn't that right? And you've heard that expression before, or you may have used that expression yourself at some point. The whole is greater than the sum of the parts. Right? Has anybody heard that expression before? Anyone? No one? Nobody ever heard of that expression? And you've never used that expression before. What does that mean? Uh, the whole is greater than sum of the parts. That means the whole. You cannot make a finished good just by just stacking up the parts, right? Isn't that right? There is something. Um, you can just because you have CPU and RAM and hard disk, hard drive, and flat panel screen, uh, you know, battery, and all these microchips, and uh, just motherboard, and just because you have these parts and components, right? And you just add them up or stack them up, or put it anyway, uh, it's not a computer. It cannot be a computer, right? Why? Because there's a certain way they have to be assembled, right? Yako saying. So then, a finished computer is the whole thing. And that expression exactly describes this situation. The whole is greater than the sum of the parts. Just because you sum all the parts, it doesn't make a computer. Also, the same thing. Think about it. A human being, they always say human being is, flesh and blood. Only flesh and blood and bone, right? There should be bone. Bone, flesh, blood, organs. Just because you just put them together, does that make a human being? If you have, flesh and blood, and just throw them into some uh, giant, mixer, and does that? Of course not. That's ridiculous. But that's why they are saying, the whole is greater than the sum of parts, right? And I think you will understand what I'm talking about. There's So in other words, when you the computer is more than just some of its components, right? The components need to be put in a certain way, assembled in a particular way. That's technology, and that's what adds value to it. And therefore, when the finished goods are uh, valued more, obviously, uh, priced at a priced higher than just the sum of its parts, right? Even the chair or carpentry chair table. I mean, you have, uh, and obviously uh, fully assembled table or fully assembled chair is priced higher than uh, DIY kit. You can buy a DIY kit and you can assemble it yourself, but obviously that's cheaper than fully assembled, right? Uh, if it is, just like a table and chairs, of course, uh, there isn't that uh, added value isn't that much, because it's low tech. I mean, anybody can assemble. Uh, but if it is high tech, there's certainly no added value. So all of this, okay, that's inventory. And in case of manufacturing, inventory includes all of those. But in case of in case of retail, in case of retail, inventory is all finished goods. Isn't that right? In case of retail, inventory means all finished goods, right? Because retail is retail, literally. They don't make anything; they just buy finished goods. So, but then retail's inventory is basically, of merchandise, right, to sell. But then think about it. Every month, uh, suppose, we go first month. Okay. Okay, we'll do quarters. Now, think about it. The basic operating cycle for any business is quarter, right? Uh, you understand? It's not month, but it's quarter. Why? Because the official report, earnings report, uh, is made quarterly. Okay, so you might wonder then, doesn't the company collect their sales record, sales revenue? In other words, data. The, don't the companies constantly collect their sales data, their revenue data, their cost data, almost on daily basis? Yes, of course, they are recorded. That's where the accounting comes in. They are recorded in their uh, 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 journals and ledgers. Okay, journals and ledgers. The entry, right? What was sold, but the journals and ledgers are recorded daily, but uh, they do not compile the data for calculating the profit uh, until until the end of the month or until the end of the quarter. Of course, they collect the data almost daily or weekly or monthly for their own internal purposes, but uh, for tax reporting purpose, right? Uh, they do it quarterly, right? And also, think about it. Companies that are being traded in the stock market, it's called, publicly held companies. Uh, Publicly held means, anybody can buy their stocks, right? Public can buy their part of their ownership. That's why it's called publicly traded or publicly held companies. In other words, um, so publicly held companies or publicly traded companies mean the companies that uh, are selling, that have sold stocks in the stock market. So their stocks are being traded in the stock market, hence publicly traded. And then if their stocks are traded in the stock market, then they have an obligation. They have an obligation to publish their or release their earnings report uh, quarterly, right? To whom? To whom? To the public, because public can, buy their stock, or someone who was already holding their stock, they can sell those stocks. So their financial information must be transparent to the public. But then how do they make it public? I mean, uh, do they announce? Do they report it in the news, or do they? I mean, what do they publish it in the newspaper? No, they do it with the SEC. Anybody heard of SEC? Hmm? Is
Yes.
there anyone there? Yeah. What is SEC? The
Securities.
Security Exchange Commission, right? Security Exchange Commission. All right. So, Security Exchange Commission is the regulatory authority in the stock market, right? And the bond market as well, stock and bond. So you have to file uh, in other words, earnings report, or your income statement detail quarterly uh, with Security Exchange Commission, and that will be available. Anybody can view this data, right? They can go into a SEC database called EDGAR database, and they can view this data. Okay, so this is how that information is released. Okay. So because of that, the basic operating cycle of any business is quarterly, right? Uh, Again, but I told you, a company that is not publicly traded or company that is privately held has no obligation to do that because they are not traded in the market. But still, for their own, it's just a accounting practice, right? You collect and compile the data and update your income statement and balance sheet on quarterly basis, right? Uh, and even the companies that are publicly traded, they collect and compile data, of course, every day, or not necessarily every day. I mean, what's being done is recording every transaction on journal and ledger on daily basis. But they compile this data weekly and monthly for their own internal purposes, right? And then quarterly, then they report it to SEC and finally update their statement. So think about it. While we so our basic operating cycle is quarterly, then they will know. Okay, or if they have been in business for some time, they know what is their average quarterly sale. In other words, what's their average quarterly revenue, right? Again, so if their average quarterly revenue is, let's say, $150,000, right? Then they will need, ordinarily, they will, when they start the quarter, they will have to have inventory of merchandise, right? That would meet this average quarterly sales level. Isn't that right? Does that make sense? Right? No, you will keep. So, but this is revenue. In other words, revenue, that means, it's not the cost, right? Cost would be, let's say, think about it. If you're Best Buy, right? You will sell computer, but the computers are, you buy computers from the manufacturers like Hewlett Packard or I don't know if Compaq is still around, but Dell or Hewlett Packard or Sony, or if you're buying computers from Dell, or the price you pay the manufacturer, the price you buy it from the manufacturer would be lower than the price you sell it for. Isn't it right? If the computer is $300 at the manufacturer, right? It's the manufacturer's price. It's also called ex-factory price. Ex-factory. What does that mean? Ex-factory means, the ex-factory price means the price leaving the factory, right? So ex-factory, if the ex-factory price is $300, they're not going to sell it for $300. Nobody's selling, anything at the cost of the price. In other words, nobody's selling anything at the price they paid for. Isn't that right? It's a common sense. So if the ex-factory price or their purchase cost is $300, then they will sell it for $500. Isn't it right? Something like that, right? It will have to be sold. So if the average sale quarterly, right? Average quarterly sale is 150K. They have to stock up. They have to stock up their merchandise to that level of retail value. But actually the cost of that merchandise cost of that merchandise. In other words, what is the cost side of this revenue? This is their average quarterly revenue. And what is the cost side of that cold? If this is the average quarterly revenue, what's the cost side of that cold? Anyone? How come everybody's just, like catatonic? Like you have been just, electrocuted, as if you are, you, you touched live wire and you got electrocuted, and as if nobody is, everyone is like brain dead. What is the cost side of the revenue? Isn't this CGS? Huh? If this is what they sell per quarter, if this is the revenue, then the cost side is called cost of that, those merchandise is called CGS, cost of goods sold, if this is what is sold, right? Okay, and that's why I said it's also called cost of revenue. What does that mean? That's the cost side of the revenue, cost of revenue, right? But anyway, we don't know if, that's average, quarterly sale. We don't know if that's exactly what's going to happen this quarter. Actually, it's going to happen. It may not, right? And also, so let's say at the beginning of this quarter, you have some merchandise already there. Let's say that is 20K. Some merchandise is already there. In other words, some inventory is already there. And what is that called? Where did it come from? That's the ending inventory from the previous quarter. Ending inventory from, what does that mean? Of course, it's left over, unsold, right? Ending inventory is the inventory left over from the previous quarter because they were unsold. So then think about it. Ending inventory of the previous quarter is the same thing as the beginning inventory of this quarter, right? Does that make sense? Ending inventory of the last quarter is the beginning inventory of this quarter. Right? Makes sense, everyone? Nobody understands? Does that mean nobody understands? This is what is this? Somebody said something. It sounds like there's a lot of static and some background noise. And what does that background noise mean? Huh? Somebody turned on the microphone. Somebody turned on the microphone, but so now think about it. And the inventory, as I said, the inventory is expressed in cost. Inventory must be expressed in cost, right? Why? Suppose you have, suppose you have 100 computers, you're Best Buy, and you have 100 computers in the store, right? These computers are 500, let's say they are all the same model by the same manufacturer, right? And then So they are all $500, but they are. But to you, I mean, when you sell it, it's $500 to the consumer. But when you bought them, they were $300. When you bought them from the manufacturer, they were $300. So there are two sides here. You can express your inventory. You can express your inventory in retail value or in cost, right? If there are 100 computers, each are 500, then in retail value, there are $50,000 worth of computers there. Right? But in cost, there are $30,000 worth of computers there in your store. Make sense? But so then, which one? Do we express the cost? Do we express the inventory in cost or in retail? Retail can express it in both, right? But then, for tax purpose, for tax reporting purpose, you must always declare it in cost. Okay, for tax reporting purpose. But for insurance purpose, maybe let's say your store got fire and everything burnt down. Nothing can be salvaged. Everything is so. Then you will have to file insurance claim, and on the insurance claim form, because you lost 100 computers in fire, they all went up in smoke. What kind of lost damage? I mean, what kind of damage value would you put there? Huh? Will you put 30K or will you put 50K?
$50.
Yes. Who is this?
Shirley.
Shirley. Okay, I like the way you're thinking. I mean, I guess you're the only one thinking with a very sensible mind, or it's only logical. Why? Sensibility. Why? You're claiming your damages on the insurance claim form, and anyway, then you will claim the greater value, because you lost $50,000 worth of computers. I mean, you lost 100 computers that are worth $50,000 in retail value, right? If you had sold them, you would have got $50,000 in revenue. So that's the revenue lost of $50,000. You would want to be compensated for that lost revenue, not the cost. And even if you claim, even if you put $50,000 on the form, the insurance company will do their best, right, to knock off, like $10,000 or $20,000. They will do their best to pay you as little as possible. So why do you give them the pleasure? Even if they will anyway try to, they are not going to pay you $50,000 anyway, most likely. But it will depend on how the insurance agreement, was. What are the articles? What are the language? What's the language? How it was worded, and if the language says it will pay for the full damage, or whatever is the there's unless it is clearly defined in the language of the insurance agreement, it can be it will have to be decided in the court, but generally it is well specified, and at least they will pay something that is equivalent to the average of the past quarters, average, sales revenue of the past, like 2 years, or 2 years. That's like 8 quarters, past 8 quarters or something like that. Okay, so all right. I think I was so I digressed a lot, but the point is, okay, so you begin the month, or you begin the quarter with the beginning inventory, which is actually the carried over from the last quarter. So it's the same thing as ending inventory of the last. And then, so if the average quarterly sale is 150K, for the cost, in cost, it is, let's say, something like 100K in cost. Okay, but again, you might be asking, oh, so that's CGS? No, not yet. Why? We haven't sold yet. I mean, it's based on the average of the past several quarters, right? So that's not the 150K is a projected average, quarterly sale, not the actual sale. Actual sale may be above or below that. If the actual sale is above that, that means our inventory cannot handle it. Our current inventory level cannot handle. But anyway, so we will have to. So if the cost side of the that average sale is 100K, with 20K alone, we cannot meet that demand. We cannot meet that demand for that quarter, for our upcoming quarter. So what do we have to do? We'll have to replenish or stock up this gap, which is 80K. Isn't that right? That 80K is called, what is that called? That's called net purchase. That's called net purchase. What does that mean? It's literally, we have to order. We'll have to order our supplier, right? Because we cannot start this quarter with only 20K. We'll have to have at least 100K worth of inventory. So we order, right? We purchase, right? We order from the 80K worth of merchandise from our supplier. So they ship it. It arrived. So we have stocked up. We have stocked up our inventory all the way up to 100K. So then, so this 100K should be called what? Now, what is that called? 20K is the beginning inventory, right? 20K is the beginning inventory. Let me use this. 20K is the beginning inventory. This 80K is net purchase. So 20K plus 80K, that's 100K. And what should that be called? That's called what? If you think about it, that is the total.
The ending
Something.
The ending inventory?
Ending inventory? No, it's not ending inventory. Ending inventory is something that's left at the end of the operating cycle, right? This is what, if you think about it, this is the total value of the merchandise that you have to sell for that quarter. Isn't that right? That's the total value of the merchandise you have to sell for that quarter. So then, what should be the name for that? The name for it is GAS. Gas? What? Oh, of course, that's an acronym. So what does that stand for? It's an acronym, of course. That stands for goods available for sale. Goods available for sale. And literally, that's what it is. This 100K is the dollar value, right? Cost on the cost-based dollar value of the merchandise, right? Total dollar value based on the cost, right? Cost-based total dollar value of the merchandise you have to sell for that quarter. Therefore, it is called GAS, goods available for sale. Okay, so GAS is basically beginning inventory plus net purchase. Okay, and then think about it. This is end of the first quarter, end of the second quarter. So let's say, and this is the dollar value, and our GAS. Currently, we have our GAS is 100K, right? And the beginning inventory was 20K. So if things go well as planned, if things go well as the ordinary, as the predicted scenario, I mean, we will be selling all of that by the end of the quarter, right? This inventory level will be depleted, right? Isn't it right? The inventory level will deplete to zero by the end of the quarter if we sell that all. But we may not. At the end of the quarter, let's say we can probably have 10K left. Okay, then that's the ending inventory of the first quarter. But that's the beginning. That will become beginning inventory of the second quarter. Does that make sense? And then at the beginning of the second quarter, they will also then because average GAS per quarter is 100K, and they will have to order this much, which is then 90K, right? Which is their net purchase in the second quarter, at the beginning of the second quarter, right? So this is basically the look at the inventory level. Inventory level will go down, right, over time, right? It will deplete, right? And another thing, but here, but if in a particular quarter the sale was so great, in a particular quarter the sale was so great, then what will happen? The inventory will deplete quickly. Then you order again. It will deplete quickly, and then order again. And if it happens like 3 times like this, then that's called turnover ratio. Inventory turnover ratio is 3, right? Inventory turned over 3 times. But here, the important thing is, okay, so you have GAS at this time, at the beginning of the first quarter, at time 0, you have GAS of 100K, right? Then what should happen next? What happens next? When you have GAS, what should happen next? I mean, think about it. Think logically. Think logically. You have merchandise to sell, so what should happen next?
CGS.
Yes, sold is the cost side. But for CGS, what should happen for CGS? What should happen so that CGS would be a relevant number? What should happen? CGS is not something that happens, it's just a result. But what happens? So what happens for the CGS to result as a as a result of that activity. When you have GAS, don't you think sale has to happen? Isn't it? Don't you think sale has to happen first? I mean, you have GAS, you have merchandise to sell, so sale has to happen. Isn't it right? Once the sale happens, then as a result, we have the cost of goods sold. Because the goods are sold, now we can calculate the cost of those goods that were sold. Right? Yeah, so in other words, think about it. In this income statement, right? Beginning inventory and net purchase. Then that's GAS, right? I didn't separately put line item GAS, but it's obvious. Beginning inventory and net purchase, that's GAS. Forget about the returns and allowances. I'm going to come back. So again, we can have returns in this time. This is the returns that we make to our supplier. Returns that we allowances. Then these are allowances that we get. But forget that. So think about it. What happens next is sale. But then sale is not here. Sale is not recorded here. Sale is recorded there. Isn't that right? Sale is recorded there. And the counterpart to that sale, on the cost side, the cost side counterpart to that sale is CGS. Isn't that right? It's the CGS. But then think about it. After returns, after GAS, then CGS must come. It's that's the sequence. That's the sequence of what happens and how that happens. You cannot have ending inventory before CGS. Isn't that right? That's how chronologically, that's how it happens. Chronologically. Isn't that right? In other words, how come everyone is just so quiet? Only one person is participating and the rest of the class is just like almost brain dead or something? Now think about it. During a regular month, what happens? The depletion of, right? This depletion of the depletion of inventory represents sale. Isn't that right? So throughout the quarter, sale is happening, and then sale would have its counterpart, sales revenue. The counterpart of the sales revenue on the cost side is CGS, right? So as the sale happens, we should have CGS, and then at the end, whatever is left unsold, that's the ending inventory. So then the order, you understand, the order or the sequence, the chronological order should be beginning inventory, net purchase, beginning inventory, net purchase, and CGS, and then lastly there should be ending inventory at the bottom, right? That's chronological. That's the chronological order. That's how it happens chronologically. But why is it switched? Why is the order of the ending inventory and CGS switched? Why are they switched? Now I think this is I'll give you this for food. I will give you this as food for thought, because we're going to take a break. We're going to take a 10-minute break. It's 4:19, so I think it's the right time to take a break, because so we'll take a 10-minute break, and when we come back, please answer me, right? Tell me why. Think about it very hard, and then give me the answer why they are switched. Okay, so we're going to take a 10-minute break. All right, we're back. We're back. So it took a little longer for me to return because during the break I've updated that file. Okay. So I want you to please, download that file again. Now, um, now we have, the file is financial statements, right? This file is now completely uh, blanked
Blank.
out. In other words, yeah, we're it should be blank. It's all blank. Okay. Other, yeah, there too. This one, I wish they could. I could preview a little more. Just this more, I mean, larger area, right? Okay. So now it is, now it is all fixed. Okay. So um, back to our discussion, and our discussion was basically about what? I mean, before going into break, I gave you this food for thought, and which was what? Um, why is the order switched, right? In other words, chronologically, what should happen? Uh, it is, so I'm gonna have to. I'm gonna have to delete or erase everything here. So think about it. Why would that be? Uh, First, we know there's beginning inventory. You begin every month, right? You begin every month with the beginning inventory, every quarter. And then there's net purchase. So together, these together are called GAS, right? If ever you add them up, it's called the GAS. I didn't put it there because it's obvious. You don't have to put it there. Rather, without that, if ever these together, bracket those two items together, GAS, and then what happens next is sale, right? With the GAS, when you have, all this merchandise to sell for that quarter, sale must happen next. I mean, that's what happens, chronologically. I mean, if you go by the timeline, yeah. And then the cost side of that sale is called CGS. So, if ever, what should come next in that in the income statement below, net purchase, it should be CGS, which is the cost side of the sale. Okay, and then after subtracting CGS, think about it. Ending inventory is the result. Of subtracting CGS from GAS. This is the chronological order. But what in the income statement they are switched, right? And why? Why are they switched? Hmm? Why are they switched? Anybody gave any thought about that? Anybody?
Is it because the end inventory is still from the previous quarter?
No.
Okay.
This is the ending inventory of this quarter.
Of this quarter. Oh, okay.
Of course, look, because ending inventory of the previous quarter is the beginning inventory of this quarter, right? This ending inventory is the outcome of this quarter.
So it's the end inventory that wasn't sold? Yeah.
Of course, ending inventory is basically the merchandise left unsold. That's ending inventory, right? Okay, so is this too hard? But so far it isn't. But this question could be hard. Why? Uh, it requires like a bird's eye view, right? You have to have vantage point to have this bird's eye view. But from the bird, think about it. What is the structure of the income statement? The structure of the income statement is basically income and expenses. Of course, in income, there is sales revenue and investment income. And in the expenses, first, CGS, CGS, and operating expenses. In other words, the number, the dollar value we want to know here is the dollar value of the CGS, not the dollar value of the ending inventory, right? In other words, CGS is the conclusion of the direct cost section, right? CGS is the conclusion of the direct cost section, not the ending inventory. You understand? Uh, this has to be, CGS has to be the conclusion of the direct cost section, not ending inventory. You understand? Ending inventory is only the chronological result of the chronological activities, right? But that's not the right? Okay, and in this section of indirect cost, OPEX is the conclusion, right? However, and it's not, there's nothing difficult about, operating expenses because it's a sum of, every line item. However, when it comes to the direct cost section, CGS is conclusion, but also is the activity there, part of the activities. So if we follow the activities, yes, CGS must happen before the ending inventory, and ending inventory will have to be the result of all those activities. But in dollar values, right, in terms of dollar value, CGS is the a conclusion. CGS is our main concern. That's why they are switched. Okay, that's why they are switched. You understand? Now, then the question is, even if we have those line items not switched, I mean, let's say CGS is still, where is it? Yeah. Even if he has put it like, in beginning inventory, net purchase, CGS, right? And even if you put it like this, you might wonder, can't we easily, find what CGS is? Can't we easily know what CGS is? I mean, you are the company. I mean, you should know your own cost of goods. Of course, the company knows. But then think about it. This income statement is not only for the company's purpose. Company doesn't, not only for company's internal purpose, but this is for what? This income statement is for external purpose. In other words, you are exposing, you are disclosing your income statement because of what? Why are you disclosing this income statement? This income statement is for the actually, uh, for outsiders to view. Why? Don't you remember? If you are a publicly traded company, right? If you're a publicly traded company in the stock market or bond market, you have the duty and obligation to provide your financial data for transparency. Isn't that right? So that the investors can know. I mean, if you're not disclosing anything about your financials, then what kind of investor? How would you expect the investor to buy your stocks, right? Or buy your bond? And I told you it is it is required by the law. If you are selling, if you sold the stocks in the stock market, and if you are selling bonds in the bond market, you have to disclose your financial your financial statements transparently, right, to the public, to the investors, right, and basically you do this, you disclose it to through what? I mean, to whom do you disclose it in the first place? I told you, SEC, right? Security Exchange Commission. So, this income statement is for external use. And do you want? I mean, obviously, you know what your true CGS is, but you don't want to. You don't want anybody to know your true CGS. You don't want. Why? Because uh, it's, first of all, your competitors. If your competitors know your true CGS, then the competitors may be able to, undercut you, right? Undercut you in terms of cost, right? Or they know how much, profit margin, gross margin, how much gross margin you have. I mean, this would be, um, these are sensitive information that you don't want the outsiders to know. Also, you don't want IRS to know. You don't want IRS to know your true cost, because if you if IRS knows your true cost, then IRS can, uh, you know, you are exposing your tax liability, true tax liability to IRS. Um, and you might wonder, I mean, don't you have to report to IRS? Yes, of course. Uh, you have to disclose everything, uh, honestly, right? But then there are some legal and technical uh, gray area where even the law allows you to do. There are some uh, uh, legitimate techniques. Um, you may there's an inventory value. So you may have heard of FIFO, LIFO, which is basically inventory valuation method techniques. depending on FIFO and LIFO, uh, it can overestimate or underestimate the true cost. But anyway, I'm gonna it will be there's another topic dedicated to inventory valuation, and also so here, so if we switch this, let's say so they switch um, and put ending inventory here, then CGS becomes the result of subtracting ending inventory from the GAS, right? Now think about it. I told you ending inventory these days it's not difficult, but in the old days, you may remember the expression taking inventory. They say, so what time did you come home last night? I was held up at work until late because we were taking inventory. What does that mean? I mean, these days, I don't know if they use that expression these days anymore, but in the old days, that was quite common expression. I mean, we did inventory. We took inventory. What does that mean? It means you were estimating the dollar value of your ending inventory. Why? Putting the dollar, and it was a manual job in the old days. Why? Suppose you have a sporting goods store, and in the sporting goods store, then you will have tennis rackets, tennis balls, and let's say a lot of things. But let's just say tennis balls. Forget about everything else. Just simplify this and tennis balls. And so at the beginning, think about it. During this quarter, tennis balls could have been purchased at different points. I mean, this quarter we are in August, so April, May, June, second quarter, July, August, September, third quarter. We're in the third quarter, so third quarter is July, August, and September. Until the end of the third quarter, I mean, we can continue to purchase the tennis balls. Some tennis balls were, so first batch was bought at the beginning of July. Second batch was bought in the middle of August. Third batch was bought at the beginning of September. And then think about it. At each different purchase point, the price could vary. Think about it. Gas price changes all the time. Beginning of July, gas price was somewhere around $4. Now it's much lower. So from the gas station's perspective, right? If you're the gas station owner, depending on at which point you purchase gas, you pay different price. But in the gas, I don't know what they call it, reservoir, or gas station has a big gas tank, right? Gas reservoir. But at the end of the third quarter, in the gas reservoir, gas tank, reservoir tank, or whatever is left there, we don't know at which point this is the residual from which month. We don't know. In other words, because gas is all gas, they all mixed up. And then if you're sporting goods store, if you own the sporting goods store, some tennis balls were bought in July, and the price was, let's say, uh, the tennis balls, they sell it by a can. Let's say 5 tennis balls in a can. Let's say that's like in a cylinder, right? Let's say the price of that cylinder was, $2 in July. August, I mean, August it was, let's say, $1.50. The batch that you purchased in September, let's say it was $2.25. Okay, and then at the end of September, at end of third quarter, there are tennis balls, a lot of tennis balls left. That's ending inventory. But what kind of, if there are 100 tennis balls left, 100 tennis balls left, what dollar price do you put on it? Huh? Think about it. What dollar price you put on it depends on when it was purchased. But these 100 tennis balls, it could be from any batch. Some of it could have come from July purchase. Some of it could have come from August purchase. Some of it could have come from September purchase. Right? If you can track it, if you can track every ball to when it was purchased, then that is a really, really tedious job. Then you can do that. Why? Because these days, everything has barcode on it, barcode, right? And if the tennis balls are still in the cylinder would have a barcode. Just scan the barcode. It will tell you what was the price that you purchased it for, and at what point, in what month they were purchased. You can just scan them, but still scanning the barcode. There are hundreds of tennis balls, and scanning the barcode on every one of those cylinders is a tedious job. But still, much better than the old days, because in the old days when there was no barcode, then how do you associate? How do you correlate it with which month? Completely. So one way they did it was, you put you use weighted average. In other words, so you use the average, weighted average, and simply multiply those 100 tennis balls with the weighted average, or use FIFO or LIFO. And I'm not going to go into that today. But if you use FIFO, depending on how the prices moved, right? If you use but you cannot switch. But once you use FIFO, you have to keep sticking to it. Once you use LIFO, you should stick to it. You may change at some point, but you cannot. It's not allowed. You cannot do it frequently. You can just change once. In in a decade or. But again, so it's a long story, but all of this is the background knowledge that would give you the logic why it is done this way, or the reasoning. It cannot be just done, in I know in accounting class they will say, you just do this, do that, do this, do that. They don't give you any logic. They don't give you any reasoning. Why it is why. In other words, understanding why is more important than what. Okay, and then so if you understand the logic, then so here, as I said, in the old days, if the company would know their true cost, but this outsiders like investors or competitors or IRS would not know the true cost, but they will have to uh, they will have to take this at face value. But then this can be either overstated or understated, right? And you might think, and most of the times, think about it. Would they overstate? Would they overstate their cost, or would they understate their cost? What do you think? Anyone? Anyone with any logical thinking?
Overstate?
Overstate. Who said that? Who said that?
Shirley.
Shirley?
Yes.
Okay, good. Yeah, that's logical thinking. At least, someone is thinking logically. Yes, of course, they would overstate. Why? By overstating their cost. Think about it. In an income statement, uh, if an income statement, right? Think about it. Uh, Income minus expenses. If they overstate CGS, this will become smaller. EBIT will become smaller. If EBIT becomes smaller, then what does that mean? After paying taxes, EBT becomes smaller. If the EBT becomes smaller, taxes will be smaller. In other words, you will be saving on taxes. So you have many companies have incentives to overstate their CGS. Okay, but then there's another side to it. Then you might wonder, oh, don't the companies all want to then make their profit look good? Hmm. Yes, so that's another story. But first, when it comes to taxes, right? They want to. So think about it. So they never tell you the true. They know the true cost because they are the manufacturer, they are the company, but they don't want to. They don't want any party know their true cost. And then, but the ending inventory once again. So they will only reveal their cost by this way, by subtracting ending inventory from the GAS. And the ending inventory, I told you, depending on what depending on whether they use weighted average method or FIFO or LIFO, this ending inventory can uh, go down or go up. But think about it. If this goes down, if this is smaller than it really is, so it's making it look smaller than it really is, or bigger than it really is. If they make it look smaller than it really is, you're subtracting smaller number, so this will be a bigger number. And the bigger number means overstating the cost. And if they overstate the cost, then taxes will be smaller. And this looks like tax fraud. No, this is all legit. I mean, because this is part of the accounting practice. A legit, using if it is the result of FIFO and LIFO, it's legit. Again, then the thing is, you cannot just switch between LIFO and FIFO at your own whim, right? Once you use FIFO, it has to be FIFO, and you can change it very rarely. Um, of course, IRS, you should convince the IRS that you had a good reason to switch it to a LIFO, right? If you were using, and then you are allowed to do it once, and then you should if you switch to a LIFO, then you should stick to LIFO for a long time until you find another good reason, compelling reason to switch it back to a FIFO or a way Returns and allowances in this case is actually, and it's negative because uh, it looks like it's cash outflow, but actually it's negative expense. Returns. Well, think about it. You returned uh, some defective merchandise to your supplier, then you will get a refund. Isn't that right? So that's cash inflow. If it is cash inflow, why is it negative? No, it's not negative. It is expressed as negative, but if you think about it, this whole section, is basically expense, meaning this whole section is money going out. This whole section is cash outflow. It's expense. Expense is what you pay, so it's cash outflow. It's a negative cash outflow, so this is actually refund you're getting, but it's a negative expense, right? But anyway, the conclusion is the same. All you need to do is, okay, now what you need to do is using auto sum, right? And voila, you arrive at, right, CGS. And then you can do the same here, all the operating expenses and all the line items in the operating expenses. There you go. And then you subtract, then think about it, from the net revenue, which is the conclusion of the income section, you subtract then sum of these two line items. Sum of these two, which is CGS and OPEX, right? And then hit enter. Voila. But then, oh, you might be shocked. Oh, then this company that's negative profit, negative EBIT. That's loss, actually, negative EBIT. Yeah, but it can happen. But that makes it more interesting. But that's all the time we have for today. I think it is yeah, all the time we have. Or someone is already booked, so I got to get ready for my office hour. So if you have any questions, please email me. And the only office hour open this week is this Thursday. So if ever you need office hour, please email me. It's always first come, first served. If someone is booked first, then that person gets it. Alrighty. So have a great afternoon, everyone, and I will see you guys tomorrow. Okay.
Cheers. Have a good one.
All right. Take care. Take
No
care.
problem, sir.
All right. Take care, Harold. So stop recording. Stop recording.